Hello, familia. Welcome back to today's episode of Crypto. Oh my God, I've got a little button-up shirt, which is like rare, but I got off a call with the SEC, and at the end they wrapped up and they said this was a really good call. So, like, very excited to be part of any contributions to the growth in this space. I was really talking around decentralization, hoping to contribute again to that safe harbor proposal that companies can use to launch and be provably decentralized. Now, aside from that, there's a bunch of interesting information, a lot of novelty that popped up today, as well as just an industry aligning behind itself for self-regulation, for making this better and healthier. Let's get into it. Bam! Now, there's obviously a lot going on in the world. We have major conflicts abound, and this has impacted the Bitcoin price. And it's been a really shitty reaction, right? It's like, hey, isn't this supposed to be sort of the counter trade, right? The thing that is against the dollar, that exists in its own vacuum. But of course, Bitcoin and all of crypto remains extremely risk on. So even though all of this is happening, there's a lot of fear. However, I did manage to suss out maybe some of the sell side pressure, and it is here that we can see Fidelity dumps about 1,820 Bitcoin. And I hate the way they phrase it. It says that Fidelity actually goes on to buy Ethereum, which could be impactful of maybe an ETF being launched, especially with the idea of staking coming into view. That is speculation on my part, but it does smell right, just given everything else going on. Of course, the opposite of that is that Bitcoin actually found a very strong bid, especially on Coinbase, which signals to us that this is a very American buy-side appetite. And we're seeing here from CoinTelegraph just in today, Bitcoin ETF saw $216 million of inflow yesterday, marking 7 straight days of positive inflow. So even though there is a sell-off, there is buy-side appetite, and this is getting voracious. Like, the amount of Bitcoin on the market is beginning to disappear. There's only so much supply. I called an OTC desk, an over-the-counter broker, the other day. They're running out of Bitcoin. So they're kind of like reaching out to whales, being like, hey, do you want to sell? Can we facilitate this? All very interesting. And of course, I would imagine that we're not really going to see a bullish trend so long as we have like an imminent World War III on the horizon. But it's my hopes that everything going on is actually very precision based and is going to be quick, rather than something like we saw with previous wars over in that region. Now, that being said, just kind of bringing us into that, there was a pretty amazing exploit conducted on behalf of the Israeli government to the Iranians, which is that Iran's largest crypto exchange, Novitex, has suffered a significant exploit, with more than $90 million being drained across multiple blockchains. This wasn't a typical theft. The attacker had a different agenda entirely. And what they did was they got in here. A lot of this was really money laundered funds being used by the IRGC, and they basically took everything and burned it. So all these posts on crypto Twitter being like, how is this relevant to me? Well, it just created a massive inflationary event of $90 million. And one fun note is that when you get in here, one of the burn addresses for Bitcoin is fuck the IRGC, terrorists, no BitX. So pretty entertaining and interesting to see that the financial side of the war is being fought. I mean, you could call this cybersecurity as well. It's very much an overlap. Again, data, information, and value are being very much blurred in the blockchain space. But we can see here basically the exploit and the burn wallet addresses for XRP, for Solana, for Dogecoin, for Bitcoin, for Tron, for Ethereum and other EVM assets, and for what looks like TON, Telegram. So interesting makeup of what's going on in that exchange. But of course, this is an exciting story and probably something that we'll see a movie made out of years from now. Now, what I really want to get into today, and what actually excites me, aside from like the hot topics of Goss, is the Blockworks article that dropped today, basically coming out with something I have screamed about to the moon on this podcast. Token markets are broken and suffer from information asymmetry and hidden risks. As somebody who's been in the venture capital game in this space, it is pretty brutal to see how many tokens are sold in these private rounds. And of course, founders get into this sort of chest pounding game with each other of who could raise the most money at the highest valuation. Now, I've said it time and time again, but these high valuations tend to be down and right performant charts when the assets release. Again, all of this private fundraise, all of that money, what's really happening is they're selling tokens for that. So you're just building up the buy side. You're accruing that sell pressure. And even though they raise, let's say, hundreds of millions of dollars, they might keep 50 million, 60 million, like half of that, just to try to support the price through market making efforts. So like, is this healthy to the market? Like, who really wins, right? You're trying to raise money and then you're using the same money to defend the sell side pressure that you've actually built up yourself. So Blockworks comes out and is really calling for an open framework. And I think this is very very straightforward to talk about, hey, we need disclosures. We need a standard format that the industry should really rely on. And this involves how many tokens are sold in the private raise. Who's the market maker? Because we've seen different market makers perform, some being kind of evil and gross, and other ones obviously being just like normal businesses. And for those who don't know, a market maker is somebody that you employ and they sit in front of the charts and they basically pad the order book with both buy orders and sell orders. What they want to do is try to contain the price. If we didn't have them, there would be these huge gaps in the bid and the ask, the buy and the sells. And you would just see this giant volatility on the charts. So they take money and they have a variety of ways to do it. Some of it's good, some of it's bad. And they basically try to trade micro trades in between so that nobody can actually explosively move the price. Their goal should be to support that price and get people to want to buy it, to create a psychological foundation, but that's not always the case. And of course, with so much sell side pressure, especially when you've done private rounds to venture capitals who owe money back to their LPs, the people that they took the money from in the first place, they are just going to sell. You mix that with bad markets, you mix that with war, they are going to begin to dump. And what we've seen in the OTC markets, the private deals behind closed doors, tokens are being sold at like an 80% discount. And that's because, again, they bought them at such a cheap round and they have such a substantial amount of tokens that they just want to get the fuck out and take the money. Now, who loses in this example? It's retail every single time. And here's a really quick layout of what they want to see, right? Supply schedules, which is, again, the unlocks, like where does the token supply hit the market? When does the token supply hit the market? Market maker and exchange listing agreements. Exchanges can ask for huge chunks of tokens, saying you've got to give them away. You've got to do all these crazy things. Related party transactions, revenue streams, very important. The relationship between the equity and the token. And this is a new topic, which is now they'll actually sell a lot of tokens with all of the revenue flowing back to the equity. So the token becomes pretty useless, and that's just a grift, and that is an uninvestable asset. Foundation token allocations, off-chain entity structures. This is all about the relationship between the founders and who has all of the tokens. We want to know where the hell these things are. So it's exciting to see the framework is being built by a group of people, a collaboration, if you will. It's open source, it's evolving, and they list a couple of the projects that contributed, like Jito, Aerodrome, Stride, Radium, so on and so forth. And it's fun because we're beginning to see people respond to this just wholeheartedly and authentically. And here you have Aerodrome Finance, one of those contributors, talking about, hey, we believe that tokens should be maximally useful and transparent. They're saying no private sales or vesting, just open structures designed to benefit all. I'm extremely excited about this. A lot of people are going to say, hey, we need private capital because we need to, pay ourselves to build these things up early. But this is a pretty interesting idea that if you build it, you can earn that back in tokens that can be earned by all of the participants in the ecosystem and hopefully go up. Again, these tokens are made to align people to support an ecosystem. How do you get alignment if the tokens are just going down? People will only use them to immediately sell. They'll have to sell more in order to make the same amount. And there's no way that you can get the positive flywheel that is kind of core to the ethos, right? That you earn these tokens. And then if they go up in value, maybe you use them to build a treasury. Maybe you use them to establish something with longevity, right? It's not a race to the bottom. And similarly, we're seeing this announcement from Coinbase during their big event last week that they're integrating Aerodrome, the DEX built on Base, into the Coinbase app itself. Now, this is pretty wild. Generally, the decentralized exchanges and the centralized exchanges were kind of seen as competition. And there was just this understanding that centralization, it allows you to run a server to match buy and sell orders like instantaneously. This is how you run what is called a CLOB, a centralized limit order book. And it just allows for the kind of depth and the liquidity and placing advanced trades that execute should XYZ happen. And that was just too much on chain, right? Each one of those little actions would have required spending gas, would have required its own smart contract. And frankly, the chain just couldn't handle that kind of throughput. However, they're now getting to the point where they can. There's a whole meta right now around CLOBs and decentralized exchanges. And what's fascinating to see is an actual exchange coming up and saying, hey, there's this place where you can trade any asset on Base. There's another product called U Assets that will let you trade like Solana assets on Base. And they basically custody and then create like a synthetic coin like Tether does. And all of this is to say, hey, you can go and trade these assets all for the price of gas. Remember, Coinbase takes a fee for every buy, for every sell. So in some ways, this is eating into their business line, but in reality, they realize that the future is on chain. Even Binance has come out to say this in the past. We do believe that DEXs are the future, and to figure out that transition is going to be a bit tough. There's going to be a tough cookie to chew on because it does impact their actual fees, but it's so necessary because that's where we're going. Now, we have another example of exactly the same thing. ByBit, the arguably second largest international exchange after Binance, doing the same exact thing, announcing the Q3 launch of their new Solana-based DEX. I guess what's sort of funny about this is they have their own ETH L2 called Mantle. So maybe the future of Mantle is not great, but what we can take away from this is that the centralized exchanges are all clearly in line with each other, that the DEX future is happening. And of course, we can see the impact happening with Hyperliquid. Hyperliquid's Hype being one of the most value accruing up to the right tokens that is in the industry in this cycle. It is just merciless. And what they did was they launched a decentralized exchange that allowed for Perps. Perps are crypto's response to options. They're on-chain versions. Unlike an option that has an expiry date, right? You can trade a future or a short that expire on a certain date, and you pay a price based off that time period. Perps allow you to do it in perpetuity, causing you to pay a fee every 8 hours. Now, that fee could either be paid to you if you're on the short side of the trade, but it really depends on the market structure. And Perps, in a nutshell, are options trading on chain. Now, Hyperliquid came out with a Perps DEX. It's awesome. Its user interface is fantastic, and its killer feature is no KYC. That's why it's closed to US citizens, but of course, there are VPNs and things of that nature. Now, Hyperliquid, you can tell, is just crushing all of the Perps volumes, and people are looking at this. And of course, Hyperliquid took no private capital. They use their fees to buy back the Hype token itself, and they have just a very virtuous cycle in their economics. So it is a danger to everyone that is sort of using their revenue to, again, go public, right? Coinbase needs that revenue to be reflected in their share price. Hype supports its own token by using each fee to burn a little bit of Hype to also build up a giant treasury that buys back and holds the Hype token itself. And with no early investors to perform for, the Hype team is really the only people that have token unlocks coming, and just, a higher price in Hype is better for them. So they have no incentive to change and alter these economics. And the more people that come on, the more people will stake the Hype that will earn some revenue and yield in the form of its own token. And it's proving to be a massive disruptor. And of course, this story only becomes further entrenched with Coinbase requesting the launch of Perps for their US market. They obviously see the value of longing and shorting, and quite frankly, it's the biggest revenue generator in the industry. Remember, people need to put a collateral on the line to go long or short, and if their position gets liquidated, that's a lot of money that comes back to the middleman. Now, in Hyperliquid's implication, that would be the treasury to buy more Hype. For Coinbase, that would be revenue to make the coin ticker go up. So you can sort of see the difference in alignment of these two business models and how they really do reward the asset holders. Do you want to be a holder of somebody on the stock market, or do you want to be in the novel, new bleeding edge of holding a blockchain asset that has this much more automated and programmed into the core of the business? Now, last but not least, we have a FOMC meeting coming up in 5, 4, 3, 2, 1. So Jerome Powell is going to go live right now, tell us what's going on with rate cuts. When the rate cuts finally happen, when we get back to quantitative easing, we're probably going to see a very explosive crypto market, especially on the altcoins. I don't expect that he's going to do it today. He's been very aggressively avoiding that with lots of political pressure. But what do I know? I'm not in the circle on this one. With that being said, it will happen at some point, and hopefully it will be great for us, for the assets that we hold. Until then, stay safe. Don't lever up out there, and I will see y'all tomorrow, fam.